So let's wrap this whole thing up. The last thing we need to really get into is the details of how an LLC actually gets taxed. In an earlier video, I had mentioned to you that a single member LLC by default is recognized by the IRS as a sole proprietorship. A sole proprietorship reports its income on a Schedule C, which is attached to your 1040. So it's all put into one tax return. There aren't separate tax returns in this instance. And this is the most common way that people are filing. With that knowledge in mind, we also know that if you establish a single member LLC today, but you're used to filing everything under your Social Security number with a 1099, nothing has really changed from a tax perspective. You're still reporting your income the same way, you're still subject to self-employment tax and all of your taxable income, and you still get the same deductions as you had before. However, there are 3 other ways that an LLC could potentially be taxed. One of them is the alternative default tax status, which occurs when you have a multi-member LLC. So if you have a business partner who owns the LLC with you, whether it's your spouse, whether it's a business partner, if there are more than 1 members of the LLC, rather than being taxed as sole proprietorship by default, you're now being taxed as a partnership by default. Amongst other implications, that partnership now requires its own tax return. And I'll tell you now that everything but the sole proprietorship, these other 3 options we're going to talk about, including partnership, they all have their own tax return. So the first implication you have to bear in mind is once you go outside of a sole proprietorship, you now are responsible for 2 tax returns. That is going to have an added cost associated to it, so it's important to understand the numbers behind what the difference in tax is going to be to make sure you can justify that cost. States like California are going to charge you $800 per year just to renew your LLC after it's been established. So some states may have annual overhead associated to even having that LLC. So we need to make sure it's worthwhile from us from a tax perspective if that's why we're going to have one. So we've established that partnerships are multi-member LLCs. Now you have 2 other tax statuses that an LLC can be elected as. One of them you're probably already familiar with. This is called the S Corporation. The S Corporation is a popular option because it gets you out of certain FICA taxes, at least to a certain extent. The problem with the S Corporation is, number 1, you get a reduced QBI deduction. If you're not familiar with that, watch our series on TICJA, the Trump tax cuts of 2018. We go into more detail on what QBI is. But an S Corporation will generally give you a reduced amount of QBI than a sole proprietorship will. Furthermore, the S Corporation has more strict compliance requirements than a Schedule C does. You have to be taking a reasonable salary, as they call it, through payroll. This is to prevent you from getting completely out of paying FICA taxes, which is why I said it only gets you out of some of it. Many people are filing as S corporations and they're not being charged any FICA tax because they're not taking any salary. And this actually goes directly against the requirements of this tax entity. So you're creating a huge liability for yourself if you're doing it that way. Now, the last way that an LLC could potentially be taxed is as a C corporation. A C corporation is where double taxation tends to occur. First, the income is reported at a corporate level on the corporation's tax return. In the either 2 instances of 1065 partnership or 1120S S corporation, the profit of the company is actually passed through to you through a K-1. In the corporate instance, the C corporation actually reports its income on the corporate return, and that is subject to the corporate tax. Now, the good news about the corporate tax is that the cap on it was reduced significantly in 2018 to a flat 21%. However, when you take your money out of the C corporation, it's passed to you. Then you're going to have to pay capital gains tax on that. So you're being taxed twice, once at the corporate level, once at the capital gains level. So you can probably see some scenarios where that could be optimal, but there aren't very many of them. It's a more rare instance, and it's usually more life circumstances than it even is income when it comes to using the C corporation. Now, before we wrap this whole thing up, I want to address there are a couple different entity types out there. Some of them are taxed as sole props by default. However, Incs and Corps, depending on your state, there's different terminology, they are actually taxed as a C corporation by default. They are not taxed as sole proprietorships or partnerships. So bear that in mind as well. If you create a corporation, your default tax status may be different than it would be if you created an LLC or a PA or a couple of other different entities that your state may or may not be offering to you. I hope this was a helpful video series. I think this is one of the biggest things that realtors are really wondering about, so I want to give you guys a clear answer on it to at least give you this base understanding so that you're no longer kind of walking in the dark with it. If you like this video and you want to see more like it, or you have a specific topic that you think we should talk about in a video as it pertains to tax or accounting for real estate agents, send an email to Daniel@rottweilertax.com. Let us know your great idea, and hopefully you'll be seeing it in a video soon. Take care.